Vietnam's economy grew 7% last year, Indonesia's 5%, the Philippines 4.5%, how about Thailand? 2.4%. Better than European countries, but dead last in Southeast Asia. And the forecasts for 2026 are even worse. The IMF just cut its Thailand projection to 1.6%. Household debt is close to 90% of GDP, one of the highest ratios in Asia. Inflation has gone negative, which sounds like good news until you realize it means businesses can't raise prices because nobody can afford to pay more. Tourism revenue is still barely half of what it was before COVID. Everybody seems to agree that Thailand is over. And honestly, looking at the macro numbers alone, that conclusion makes sense. I almost bought that narrative too, until I started looking at what's actually happening on the ground. While YouTube was busy writing the obituary, Google opened a cloud region in Bangkok this year. Amazon has committed $5 billion to Thai infrastructure, Microsoft another $1 billion just last month. But the icing on the cake is Thailand's investment board, which just closed the biggest year of foreign capital in its entire 60-year history. Somebody is obviously wrong here. Either it's all the commentators calling this a dying economy, or it's the companies putting billions on the line. In this video, I'm going to show you the Thailand that actually exists behind the headlines, where the real money is actually going right now, who's putting it there, and why it matters for anyone watching Asia right now. I'm Bertrand, I've been working in Asia for 26 years. This channel is where I share my view from the inside. If that's the kind of thing you want in your feed, hit subscribe. Let's start with the ugly stuff, because there's a lot of it. And anyone trying to sell you a fancy picture of Thailand right now is either lying or hasn't looked at the numbers. The household debt situation is getting worse than the headline ratio suggests. When you owe almost as much as the entire country produces in a year, most of your paycheck is gone before it even lands in your account. Thai families spend a huge chunk of their income just servicing old loans. And it's not because they stop spending. Anyone who's been to Thailand knows people eat out every day and line up for the latest iPhone. The problem is they're doing all of that on credit, often at interest rates that will be illegal in most Western countries. Domestic consumption, which is supposed to be the engine of any healthy economy, is basically on life support. Banks are tightening lending because default risk keeps climbing. Consumer loans have been shrinking for 4 quarters straight, and the overall banking system has posted 6 consecutive quarters of negative loan growth, the longest stretch since the 2009 financial crisis. It's a slow-motion squeeze on the entire middle class. Then there's the inflation problem, which most people get completely backwards. Thailand's inflation has been negative for 12 months straight, the longest deflation streak since COVID. In a country where prices are going up everywhere else in the world, that sounds like a win. It's not. Zero inflation means businesses can't raise their prices because their customers are too broke to accept higher bills. It means landlords can't increase rent, factories can't pass on rising costs, and wages stay flat because there's no upward pressure anywhere in the system. Japan went through the exact same thing starting in the 90s and took them 3 decades to climb out. Economists have publicly warned that Thailand risks repeating Japan's experience where prices stayed stagnant for decades and the economy got stuck in a deflationary trap. Tourism is the third piece of the puzzle, and it's messier than people think. Yes, Chinese visitors collapsed, down to less than half of the pre-COVID numbers after the scam compound scandals and the No More Bets film destroyed Thailand's image in China. But the real problem is that even the tourists who do come are spending far less than they used to. Hotel rates went up, the baht stays strong, and budget travelers now see Vietnam and Indonesia as better value. The average hotel, restaurant, or tour operator is still stuck at 44% of what they made in 2019. Malaysia just overtook China as the top source of visitors to Thailand. But the stock market is maybe the most telling indicator of all, because it's where global capital votes with real money. In 2025, the S&P 50 dropped 23%, making it the worst performing major index in the world. Foreign investors pulled out over 100 billion baht in net outflows. Trading volumes hit a 20-year low. A series of corporate scandals with Stark, JKN Global, or Energy Absolute wiped out billions in shareholder value and shattered what was left of investor trust. The market has recovered a bit in early 2026, but it's still trading at one of the lowest price-to-book ratios in Asia, about half of Vietnam and a third of Indonesia's. When global investors look at Thailand, they see risk they don't want to price. And underneath all of this, there's a slower, more fundamental problem. The population is aging faster than the economy is growing. Thailand's fertility rate is now lower than most of Europe's. The working-age population started started shrinking in 2019 and the decline is accelerating. By the 2040s, the country could be losing about 1% of its workforce every year. An aging population means fewer workers paying taxes, more retirees drawing pensions, and slower productivity growth. Thailand is aging before it finished getting rich, and that's a very hard hole to climb out of. Whew. That's a lot, right? So if you add it all up, yes, the picture is far from perfect, but there's just one thing that doesn't fit in that particular picture. Earlier in April, Moody's, one of the three major rating agencies, upgraded Thailand's outlook from negative to stable. The reasons? Easing tariff risk, structural reforms, and, I quote, sustained momentum in foreign direct investment. An agency whose entire job is to price risk, look at the same country everyone on YouTube just buried, and decided things are stabilizing. Last October, Thailand's Board of Investment announced that foreign investment application had hit 1.37 trillion baht in just the first 9 months of 2025. That's around $42 billion, the highest number the BRI has ever recorded in its entire 60-year existence. Spoiler, part of it comes from StatRes. Guess the number. The full year total came at plus 67% from the year before, foreign direct investment alone accounting for 72% of it. So, you've got one story being told on Twitter and YouTube, Thailand is finished, and you've got another story being told by Moody's. These two stories cannot both be right. Usually, when there's this kind of gap between the headlines and the money wins. Because the money has spent months doing due diligence and doesn't care about the narrative. It only cares about what it can build and what it can earn. So, what are these companies and investors seeing that nobody else is talking about? Well, the answer comes down to three specific bets. I've been working in Asia for 26 years. I work with the companies that are setting up here, and I share what I see, what's actually happening from the inside. If that sounds useful to you, hit subscribe. Start with the cloud stuff, because that's where the biggest checks are being written. In January last year, Amazon launched its first ever cloud region in Thailand. $5 billion committed over 15 years, 3 data center zones, full infrastructure, the works. AWS estimates the project will add around $10 billion to Thai GDP and create 11,000 jobs a year. Exactly 1 year later, in January this year, Google followed. A $1 billion investment, a new banker cloud region, and a projection of $41 billion in economic value to Thailand over 5 years. 130,000 jobs a year on average. Microsoft made the same move and announced $1 billion plus over the next 2 years, specifically for cloud and AI infrastructure. And that's before counting ByteDance, which has committed several $1 billion to Thai data hosting for TikTok's operation across the region. Add it up, and you're looking at around $15 billion of hyperscaler money landing in Thailand in 18 months. The Thai Board of Investment classified 119 digital sector projects for 2025 alone, worth over 600 billion baht. For the first time in the country's history, digital infrastructure became the single biggest category of foreign investment, beating electronics and automotive. Now about the car story. You probably heard that BYD built a factory in Rayong. What you might not know is that it took them 16 months to roll out their 70,000th vehicle, or that starting in August 2025, they began shipping cars from Thailand directly to Germany, Belgium, the Netherlands, and the UK. That supply chain didn't exist 3 years ago. And BYD is just the loudest one. Great Wall Motor dropped $647 million into a Thai plant. Chang'an added close to $300 million. GAC Iron, Chery, MG are all building. The Chinese EV makers have collectively deployed over $3 billion in Thai manufacturing, with approved capacity to build more than 270,000 vehicles a year. And the Thai EV market has absolutely exploded. Chinese brands now control close to 85% of the EV segment, with BYD alone holding around 40%. I told you in my video about BYD. Thailand has become the backdoor into Europe, and the Detroit of Asia is being reborn. Not with Japanese car makers this time, but with Chinese ones using Thailand as their tariff-free gateway. Which brings us to another story almost nobody is telling. If you open up your phone right now, or your laptop, or any server running anywhere in the world, you'll find a green rectangle inside it, a printed circuit board. And there's a good chance that rectangle was made or about to be made in Thailand. Since 2022, more than 200 billion baht was poured into Thai PCB manufacturing. 7 of the 10 larger Chinese PCB makers have set up shop in the country. In January, the world's single biggest PCB manufacturer infrastructure, Jending Tech from Taiwan get approval for a $2 billion joint venture in Prachinburi. High-density circuit boards for AI servers, 5,600 jobs. Western Digital expanding its Thai operation with 23 billion baht in new approvals. Delta Electronics moved part of its North American production to Thailand, specifically to dodge US tariffs on Chinese-made electronics. This is the China Plus One strategy becoming real right now. Vietnam got the low-cost assembly, Thailand got the capital-intensive, technically complex, high-margin work. It's not the kind of industry that shows up on tourist Instagram, but it's worth more than every beach resort in Phuket combined. I'm not here to tell you that Thailand is some kind of a guaranteed winner, and even the good Thailand story has cracks. The big infrastructure that's supposed to tie everything together, like the high-speed rail connecting Bangkok 3 airports, the U-Tapao expansion, the deep-sea port upgrades, is years beyond schedule. That's the part the cheerleaders won't tell you. That's the part YouTube is also missing on the opposite side. But the transition is happening. We see it every day at Statris. We have offices in Bangkok and we talk to entrepreneurs and companies setting up here, and the money isn't showing up for fun. These are serious players with serious capital making serious bets. If you only look at GDP growth, household debt, and tourist arrivals, yes, Thailand is not doing so great. But the companies writing the biggest checks in Asia right now look at the exact same numbers and bet billions on the opposite. Whether that makes them contrarians or fools depends on which Thailand you're betting on. The one that's suffering or the one being built in parallel. If you learn anything valuable from this video, hit subscribe. If you spent time in Thailand recently or you're running anything connecting to this part of the world, drop it in the comments. I want to hear what you're seeing on the ground. See you in the next video.